impact on people, process, and profits. Before we start today's call, we'd like to share a couple of housekeeping items. This webinar is being recorded. All materials were emailed to registrants around 10:15 this morning. You can also find the materials on our Coronavirus Resource Center at rklcpa.com. All lines are muted and will remain muted during the webinar. Questions can be submitted through using the Q&A button at the bottom of your screen. However, due to the size of the group today with more than 700 registrants, we will only have time to address a few questions throughout the webinar. RKL clients who have questions specific to their organizations should reach out directly to your RKL advisor. 1 hour of CPE in the field of business law will be issued to participants on this call. To be eligible for CPE, participants must be connected to the session, both audio and presentation, for its entirety. Additionally, participants must answer 3 questions as elements of engagement through the polling feature. If you're viewing through a web browser, ensure that you have pop-ups enabled. Please make sure Zoom is your primary window in focus. If the question does not show, just click the presentation screen and the question should display. If you're using multiple monitors, the poll may appear on your second screen. At this time, I would like to turn the presentation over to Eric Wenger, who will introduce our team for today's webinar. Eric, the floor is yours.
Well, thank you, Steph, and welcome back to everyone. This is becoming quite a Friday tradition here. This is the 5th in our series of the coronavirus updates that we've been sharing, and we're so thrilled to have so many with us and update you today on what we're aware of. And we're going to start out today talking about the PPP, the Paycheck Protection Program. What's the status? Where are we at with that? And a lot of questions around the forgiveness provisions. Next up, Trish Richardson is joining us from our Human Capital Management practice. Trish is going to talk about payroll tax reporting in a post-coronavirus world. As you know, and as we've been talking about over the past several weeks, there's a number of new credits, and many of those credits are claimed in payroll tax returns. And so the reporting for payroll has suddenly become a whole lot more complex, and Trish is going to help navigate us through those conversations. After that, Carrie Booth, who is one of our tax partners, will be speaking about the net operating loss carryback procedures and a lot of the planning opportunities that can relate to maximizing those losses. And then Nick Boyer is back with us again this week. Nick had joined us last week and was giving us sort of a macro view of the overall economy. And today he's going to be talking about, more specifically, how does that, what sort of investment strategies should be employed during these turbulent markets. All right, well, you probably saw the headlines yesterday that the PPP well has run dry. And if you go to the SBA's website this morning, you're going to see this blurb, which is screenshotted here. It's in small print, but what it says is the SBA is currently unable to accept new applications for the Paycheck Protection Program based on available appropriations funding. Similarly, we are unable to enroll new PPP lenders at this time. I would tell you right now, there's a whole bunch of different mixed emotions among companies out there, business owners today. There's quite a few who are happy. They have either already received cash, that's probably not the majority, but some have actually received funding. A number of them have received notification back from their bank that they received an SBA number, and essentially they're in line and funds have been earmarked for them, and those funds will come no later than 10 days after that approval. And then there's a whole bunch of companies that are sort of in limbo. They put in an application, they may or may not know exactly where they stand with it, and they're nervous. And so the question then arises, will PPP be refilled? And that's the term that Congress is using, this discussion around refilling. And they started these conversations a couple weeks ago, but at this moment, we still don't have much clarity. There's 2 quotes here, one from the Wall Street Journal, the other from New York Times. I'm just going to read these because I think it very concisely sort of sums up where we're at this moment. Both Democrats and Republicans want to add $250 billion to the small business aid program, but have been sparring for days over whether to add restrictions to the funds. Democrats want to expand access to the loans, as well as include more money for hospitals, food assistance, and state and local governments. Republicans, meanwhile, said they want to keep the bill focused on increasing small business aid and defer other funding debates until the next broader legislation is crafted. And then the New York Times commented, Democrats have insisted on attaching new restrictions to ensure the money flows to minority-owned businesses and other companies that are traditionally disadvantaged in the lending market. So what does that mean? I think, many people can take some solace in the idea that, both Democrats and Republicans want to add more funds to this. But at the moment, we don't know if or when that will occur, and if the criteria may be a little bit different as far as qualification. And I would say, speak to your banker about if you haven't already gotten in line, if it's worth getting in line, and how prioritization may be determined if there are more funds to come. We want to talk here about, the framework of PPP, which we've been talking about for the past several weeks. On its face, it appears fairly straightforward. The concepts we've been talking about, payroll costs are forgivable costs. You'll recall that those are capped at $100,000 in cash per employee. And there is also this caveat that came out in a little bit further guidance that said 75% of your total loan forgiveness has to be for comp and benefits. So you can't just have a whole bunch of utility and mortgage interest costs. You need to have at least 75% toward personnel. Another deductible, or not deductible, but forgivable expense is interest on a mortgage obligation, rent, and utilities. So again, fairly straightforward. It's what we've been talking about. However, there are two slides here, which we're going to talk about just some of the many questions that have arisen that are unclear, quite candidly. And unfortunately, you're not going to be able to walk away from today's webinar with a full understanding of forgiveness. And the reason I say that is we've been getting bombarded with questions, and unfortunately, the guidance just isn't there. And so some of the examples of questions that have been coming in, full-time equivalent counts. As you know, there's a haircut if you don't have enough FTEs relative to prior pay periods. And that could be 2019, it could be 2020, depending on which way you elect. Exactly how do you count them? How are part-timers counted? There's a lot of questions there. There's also some provisions that say if you restore your head count, your FTE count by June 30th, well, then maybe you're okay. And if that's the case, can a company wait until, June 28th and onboard a bunch of people and have that impact their count? Is it prorated? There's a lot of questions around that. The second bullet point, are there rehiring limitations related to getting that full-time equivalent? Another interesting question, this came up in some restaurant discussions. What if the restaurant simply can't open and they say, well, do we have to hire waiters, waitresses, hostesses, or could we hire some construction employees to renovate our restaurant? Do they have to be in similar positions is the question. And honestly, that isn't entirely clear at this point. How about timing of payroll? And there's a lot of questions on that. Remember how this program starts from you have 60 days. You have 60 days and that clock starts when your funding hits the bank, whatever day that may be. And within that 60-day period, you need to be, incurring costs that can be forgiven. Well, what if that doesn't align perfectly with your payroll? And, can you do another interim pay? Are you able to prorate it? Is it based on paid and incurred? Is it just based on when you pay it? What if you pay large bonuses? What if you fund your retirement plan, profit sharing for the year? Is that prorated? I'm asking a lot of questions because quite honestly, we have a lot of questions. And these are the sort of things that companies are talking about. How does this work? On the next slide, what if a business has been closed by the governor and the ownership says, you know what, we honestly don't really want to use our loan proceeds to pay people who are not at work and are not able to work for us. They can't work remotely. And so what if we use those proceeds for some other purpose? And does that risk them putting them into some sort of, risky position or maybe even a fraudulent position, depending on how the SBA were to view that? Of course, the intent of this legislation is to keep people employed, keep businesses open. But, as time has gone by, this gets more complicated. Renting real estate, we talked about rent as a deductible expense. What if it's a related owner, which is very common, that you have a self-rent, and the questions come up around, well, can I raise my rent? Did I charge my entity and have that be deductible? At this point, again, there's not really specific guidance on that. Another question around rents, is it just real estate or what about personal property? What if we're renting vehicles? What if we rent copiers? What if we rent other equipment? Are those forgivable rent expenses? Unknown. Another huge question, will the forgiven expenses be tax deductible? And so we already know from the CARES Act that the receipt of the income from the SBA, the funds that come in are tax-free, but is there a gotcha in here, which is under Internal Revenue Code Section 265, and that principle has existed for a long time, and it simply says if you have expenses allocable to tax-exempt income, then those expenses are not deductible. So if we pay a bunch of payroll that we didn't have to pay tax on that income that funded that payroll, do we get a deduction for 2 months worth of payroll or not? It's a huge question. And honestly, it's going to require some further clarity to be confident of what the answer to that is. There's some questions around gross versus net when you're getting forgiveness. On the initial application, it was clearly gross. On the forgiveness piece, there's some discussion. It may actually be based on net payroll, meaning net of taxes. And finally, and perhaps most importantly, how is each bank going to interpret and apply the rules from the SBA? Because really the banks are the gatekeeper and the police on these provisions, and because the guidance continues to change, it's not always entirely clear. So I just threw a lot of stuff at you to probably make you feel like, man, we have no clue, which in some ways is true. What do you do with that? Despite the outstanding questions, you should start keeping records, and meticulous records about, if you have received funds or if you're about to receive funds, how are you spending those dollars, earmarking them, perhaps setting up general ledger tracking codes that you can identify easily that this was a qualified expense. There's some discussion around opening a separate bank account. That's not mandatory. In fact, one banker told me yesterday that may not even be realistic in this environment because of having to show up in person to potentially open a bank account. So that, again, that's not a mandatory issue, but something that may be a best practice. I just wanted to touch on here something that we're going to spend a lot more time on in next week's webinar, and that is a discussion around what is RKL doing to try to understand this. Based on all those ambiguities that I just walked through, we're not at a point to be able to roll out something today that very clearly helps companies understand, because there's too much uncertainty. We expect in the next week, and hopefully it's next week and not 3 weeks from now, but hopefully we'll have guidance soon. And we're in the process of developing a tool, a very robust tool that's going to help companies to look at not only the forgiveness piece, but monitoring and managing their cash flow related to that with dashboards, basically putting a company in a scenario where they can look at projections in the midst of all this ambiguity and uncertainty. How do they make decisions that are going to make their cash flow work, that will maximize their PPP forgiveness? Look at, well, what if running a variety of what if scenarios? What if I bring back this group of employees? What if I lay off that group of employees? What if my rent is this? What if I pay a large bonus? What if my revenue has dropped by X% from my customers? How's that going to impact my overall cash flow? All these pieces are integrated into I saw it demoed yesterday. It's in beta testing right now, but it's an impressive tool, and it's something that we're going to be working with clients. And so next week we're going to spend a lot more time. It'll be ready to rock and roll, and talk with you guys about that specifically. At this point, I'd like to move to our first polling question. Just a reminder that in order to be eligible for today's CPE credit, for the CPAs in the audience, you do need to answer 3 of our polling questions today. Our first polling question is, has your company received its PPP loan? The options here, yes, not yet, we didn't apply, or I don't know. We're going to keep that question up here, and in the meantime, I'm going to advance us to the next slide. And our next presenter is Trish Richardson. Take it away, Trish.
Hi, thanks, Eric. So let's talk about the nitty-gritty about payroll tax reporting now that we've started paying folks and under these 2 pieces of legislation. So there's 2 pieces of legislation available at this time that have payroll tax credits. One is the Families First Coronavirus Response Act, or the FFCRA, and this was the first one that was released out to businesses, and this includes the Emergency Paid Family and Sick Leave, or EPSL. Then we have the CARES Act, which includes the Employee Retention Tax Credit, the Payroll Tax Deferral, and the Payroll Protection Program Loan, or the PPP. So those are the two types of legislation. Let's talk about qualified health plan expenses. One of the things that we're seeing in the credits are wages to include qualified health plan expenses. So what does that really mean? These qualified health plan expenses are included in the emergency paid family and sick leave, the employee retention tax credit, and the PPP loans. What's included in qualified health plan expenses are basically the full invoice cost of any plans you have in your Section 125. So there has been some confusion about, do you include the employee's pre-tax deductions? Do you take that out? So just look at the full invoice cost, and that's what you're going to use for that number. HRAs and FSAs are also included in qualified health plan expenses. What is not included are the QSARAs, and those are small business health reimbursement arrangements. Any health plan expenses paid post-tax by employees, and those are things like your AFLAC plans that your employee may have chosen on their own, and then any HSA employer contribution. All right, so let's talk about the FFCRA. One of the things that you want to make sure you're doing as you're paying employees these emergency paid sick leave funds is that you have separate earning codes for these payments. The reason you want to do that is multiple. So you have limits, you have threshold limits, either the $511 or the $200 per day, and you also have maximum amounts you can pay employees. Also, the taxation is very unique. These earnings for the employee, they're fully taxable to everything except your Social Security match as the employer. So you want to make sure that you are treating this as a separate earning. Plus, it helps you track the expenses differently and helps you do reporting if you need that. We've provided some sample earning codes, but at this point, your payroll provider has probably already established what they are using as these earning codes because of the taxation issues with those. All right, some other things you want to consider when you're talking about the FFCRA. Are those earnings 401k eligible? So if you have any type of retirement plan, 403B, 401k, things like that, these might be considered earnings under your 401k plan. So you want to make sure that you are handling those deferrals correctly. So if the employee has a 5% deferral on wages, you may have to include that 5% deferral when you're paying them these emergency paid sick leave funds. And you also may have to provide the match as the employer. So look at your plan, but also talk to your broker for more guidance. Talk to your payroll provider about how they're handling these credits because they're based on payroll taxes. And the payroll providers their system isn't really designed to handle this type of unique situation. They are having to rebuild their systems. So have the conversation, where are we with this? What are you doing? And just a plan for that. If you decide that you want to go back and reclassify payments that you've already provided to employees that might qualify under the emergency paid sick leave, you can go back to the April 1st wages, which is when this first became effective, but make sure that you work with your payroll provider, or if you're processing payroll in-house, work with your the system that you use to process payroll to make sure that those wages are being calculated correctly for the tax and just to be tracked for those limits as well. And then one thing to remember about the FFCRA is this is also emergency family medical leave. And there's a lot of documentation you want to have in place for family medical leave. So definitely you want to document, why is this employee getting paid? Is it a child care issue, or have they actually been diagnosed with COVID? So you want to make sure that you have that documentation in place, just like you would regular FMLA. All right, so let's move on to the CARES Act. The Employee Retention Tax Credit under the CARES Act, you can get a retention tax credit for qualified wages, which includes those qualified health plan expenses, paid after March 12th, but before January 1st, and you can get 50% of the wages paid in a calendar quarter for each employee. So the next slide shows an example, so you can always go back and look at that, because this wording can be a little tricky in this retention tax credit, because a lot of us are seeing $10,000. $10,000 are the qualified wages. The credit itself is only $5,000. So important thing to remember when you're looking at these different pieces of payroll tax relief. And for the employee retention tax credit, there is a difference in how you have to treat these wages, what's qualified wages, based on your employee count. So 100 or less employees in 2019, it includes all the wages. All your wages are qualified. If you had more than 100 employees in 2019, the only qualified wages are those you paid to the employee because they could not work due to COVID-19. The one exception for the retention tax credit, if you've received a PPP, you cannot also take this employee retention tax credit. So keep that in mind as you're looking at these different tax credits available to you. So here's the slide I mentioned earlier about showing you the math of how you would calculate that $5,000 credit. You have to look at it quarterly because we reconcile our payroll taxes quarterly on Form 941, but you also have to look at it in the aggregate. So you can always go back on the PDF and take a look at this to see how that formula might work for you. All right, so now you have all these programs in place. How do you actually get the money? So that's one of the questions really coming up now. Okay, great, we know we're supposed to get it. How do we get it? So under the Emergency Paid Family and Sick Leave and the Employee Retention Tax Credit, you can reduce your 941 payment by all those credits available to you. So under the Emergency Paid Family and Sick Leave, you have the employee payments and taxes. So there's a lot available to you. And you can reduce your 941 payment that you make every payroll by those credits. Now, with qualified health expenses being included in the credits available, you are very likely to have no 941 payment due and still need a credit on top of that. So you can get that additional credit one of two ways. You can complete Form 7200 and fax it to the IRS. Form 7200 is not as bad. Sometimes we hear IRS form and there's this angst. They've created it in a way that it's kind of user-friendly. You can do this Form 7200 after every single payroll if you want to get those credits back if it's beyond what your 941 payment would have been. Or you can wait till the end of the quarter and reconcile everything on your 941 form. This is the part where you really want to communicate with your payroll provider how they are doing this for you, because typically they're filing your 941, they're collecting your money, and they're sending the payments in. So have that conversation. For the payroll tax deferral, this isn't really a tax credit. You're not being relieved of the tax. They're just allowing you to defer your payments. And the payments that you can defer are your match of the Social Security, so the employer portion of Social Security. And that is for wages paid between March 27th and December 31st. So you can hold that money back and wait until December 31st, 2021, and remit the first 50%, and then the remaining is due a year later. And then we have the PPP loan, which isn't a tax credit, but based on what Eric mentioned earlier, you can have some loan forgiveness. So these are the different ways you can receive these credits and all the money that we're told we can get back or we don't have to pay. All right, one of the things that we're seeing on the HR team, and this is really great, is employers are wanting to incentivize employees to come back to work, understanding that we're all a little uncomfortable. You know, is it okay to go outside? Is it okay to be around people and work? So we're calling this thank you pay options. And I wanted to talk about a few of these just for an understanding of how you might want to manage these if you're offering them. One really good example is just add an additional per hour rate. We have some clients that are doing that. They're saying, you know, we're going to add an extra $1 to your hourly rate until the end of April, the end of June, whatever time frame you want, to just kind of a thank you for coming back to work, for bearing with us, to help build that employee-employer relationship. Then there's an ad hoc bonus or spot bonus. And those are great. Those are just, hey, thanks for coming back. Here's $100. And it's a one-time only. It wasn't expected. It's just a really nice thank you. You can also do a percentage of the employee's regular or overtime rate combined, or overtime earnings, sorry. So this is a really nice thank you pay to consider if you need your employees to come back to work and they're just so fearful that you're having a hard time getting them to come back to work. How this works is you could say for every week you work or every pay period you work, we're going to take 1% of your regular and overtime earnings and give that to you as a bonus on your next pay. So it incentivizes them to work more. If I work more, I'm paid more, my bonus is more. And it's a great motivator. The math is easy and definitely something you want to consider using. Now, I kept this flat amount bonus thank you payment separate because it can be tricky and you want to make sure that you're navigating this one correctly. So this would be something like, for every week, we're going to give you an extra $100. For coming into work, we're giving you this $100 bonus every week. So the Department of Labor calls this type of bonus non-discretionary, which means the employee is expecting it, you don't have the option not to pay it. And with these types of bonuses, if an employee is working overtime, an hourly employee, you actually have to include this bonus in the calculation of their overtime rate. So something to think about, there's going to be additional math. You're going to have an additional administrative burden on this piece. But I'm not discouraging you from doing it. Just understand that you're going to have a few extra steps involved with this. So you know your employee population, pick the type of bonus plan or thank you option that you think would be best for you and your employees. And so now we're going to do a polling question. Remember, to be eligible for the CPEs, you have to answer all three of the polling questions that you're provided. So this one's a pretty easy polling question. Are you confident in your payroll and HR compliance processes and options during COVID-19? If you're not, or if you're, I like to call it trust but verify. I think I'm doing this right, but am I doing this right? The HR team at RKL, we're here for you. We will field questions. We'll help walk you through different scenarios. So please think about that. You're not alone. This is very challenging for our profession because not only are we dealing with the payroll tax credits, but also the employee piece, the human piece of this. So we're here for you if you need us. And now I think I'm going to hand this over to Carrie, who's going to talk about the CARES Act.
Thanks, Trish. I appreciate that. Good morning, everyone. In the next few slides, I'm going to walk you through some of the background, process, planning opportunities, and also potential pitfalls to one of the key CARES Act provisions that provides an opportunity for business taxpayers and shareholders to increase cash liquidity. That's the NOL carryback provisions. While on the surface, this might seem like a really simple concept, there are a lot of nuances that need to be considered. So in the time allotted, I'm really just going to scratch the surface on this topic. Each taxpayer really needs to evaluate the benefits based on their own facts and circumstances. So let's dive in. What did the CARES Act change with regard to NOLs? So we're just going to really briefly touch on the rules prior to the CARES Act, just to kind of level set everyone. So the Tax Cuts and Jobs Act of 2017, the TCJA, obviously changed the rules related to federal NOLs. So it took NOLs generated after 2017 and said they can no longer be carried back. Utilization is limited to 80% of taxable income in future years. And kind of as a trade-off, we're going to now let you carry forward those NOLs indefinitely. As many of you are aware, prior to the TCJA, NOL could be generally carried back 2 years and carried forward 20 years with the ability to offset 100% of taxable income. Now, the CARES Act came in a way to provide relief to business taxpayers and individuals as well. It lifted the carryback and taxable income restrictions for NOLs generated in tax years beginning after December 31st, 2017 and before January 1st, 2021, and permitted a 5-year carryback of those NOLs arising in those tax years. So we're really talking about years 2018, 2019, and 2020. As a result, it's now possible to carry back an NOL generated in 2018 to offset taxable income as far back as 2013. It also makes there's also a retroactive technical correction that impacts some fiscal year-end taxpayers as well that kind of gives them an additional carryback period too. So as you can just see on the surface, the provision creates a significant opportunity to help companies improve their cash position. So obviously, as an example, a company that incurred or will incur a loss in any of the 2018 to 2020 years, but was profitable in prior years, can now carry back NOL to claim cash refunds. So next slide then, I have a nice chart that really summarizes all those words, and I'm not going to go through this in detail. You can read it, you can use it as a handy guide. Just the one important item to note that maybe seems a little tricky is that an NOL generated in the time period specified under the CARES Act can only offset 100% of taxable income for tax years beginning prior to January 1st, 2021. After that, the limitation does, in fact, revert back to 80% of taxable income. So just because the NOL, was generated in a CARES Act year, it doesn't mean that that particular NOL can offset 100% of taxable income indefinitely after that period. So just how does one go about taking advantage of the NOL carryback provisions? Well, of course, just like everything tax-related, there are processes and procedures that need to be followed in order to try to get the most expeditious refund of your cash, if that so is your case. So prior to last Thursday, there was actually a lot of open questions regarding how one should do this that hadn't been defined in the CARES Act. But on Thursday, then April 9th, the IRS came out with Rev Proc 2020-24 and Notice 2020-26, which both provide guidance on how to take advantage of the NOL provisions in the CARES Act. So just, I'm going to try and touch on this kind of quickly, but just to give you an overview, the quickest way to obtain a refund from an NOL carryback is to request a tentative refund. That's done so on Form 1139 for corporate taxpayers and Form 1045 for taxpayers other than corporations. It's a way to obtain what they would call a quick refund, because under this procedure, the IRS conducts just a limited exam of the application and they make the resulting credit or refund, or are supposed to, within 90 days of filing the application. Now, they did come out and say also these applications can be faxed in to try and expedite the process. But one thing to note that I've actually heard listening into another webcast is that the IRS, Ogden, is the IRS website that largely processes these applications. And that as a result of everything going on, they are largely shut down. And even if you think about it, if they're not shut down, they're not staffed to handle the inundation of applications that they're going to receive. So, while nothing's been said, I think it would be reasonable to assume that there could possibly be potential holdups with the 90 days. Hopefully that's not the case and taxpayers can get their cash back quickly, but I think it might be something where there's going to be the potential that we need to be patient. The IRS did, in fact, grant a 6-month extension of the deadline for filing these applications. This would impact certain taxpayers because you typically only have a certain amount of time to file these applications, and otherwise would have needed to file an amended return. So, just a quick example, in the case of an NOL that arose for a taxable year, a taxpayer for a taxable year ending on December 31st, 2018, a taxpayer normally would have only had until December 31st, 2019 to file this form. But due to these new rules, that particular taxpayer would now actually have until June 30th, 2020 to do so. And there are rules around the extension for certain fiscal year ended taxpayers with the year end on or before June 30th, 2019 as well. Procedurally, NOLs are carried back to each of the 5 taxable years preceding the NOL year. They're going to be first applied to the earliest tax year of income in the carryback period, and then they'll be carried forward, any unused amounts will actually be carried forward into succeeding years. A taxpayer does have the ability to choose to elect to waive an NOL carryback. And you might be thinking, well, why would anyone do that? I would want to carry back my NOL and get the cash. Well, we're going to talk about a little bit later on another slide closer to the end. There are some situations where it might not actually be advantageous or as advantageous to carry back an NOL. So certain taxpayers may actually want to elect out of this. And you should refer to the rules mentioned at the top of the slide regarding the guidelines to elect out. They're a little bit detailed. Normally you do so on your return, but to the extent your return's already been filed in the years past, there are some special rules that they came out with. So let's take a look now at a few planning opportunities that you may be able to utilize and put into effect in order to maximize some NOL carryback benefits if you are so eligible. So when the TCJA, originally reduced tax rates, I'll give an example of corporate taxpayers from 35% to 21%, there was a lot of talk and a lot of opportunity at that time to invoke tax accounting method changes in order to try to accelerate deductions into a higher tax rate year and defer income into a lower tax rate year to really just take advantage of that rate arbitrage. Well, this same example now exists again. So you now have the ability to potentially accelerate deductions into a year, create an NOL in a lower tax rate year that you can carry back and get a benefit when you had a higher tax rate. So it's really kind of the same situation. So let's just high level take a look at a couple of tax planning strategies that may be able to put into effect to maximize NOL carryback benefits. One thing important to note, many tax accounting method changes are automatic in nature. They can be filed with the taxpayer's timely filed return with extensions, including extensions, and there aren't any user fees for automatic method changes, and they don't require prior approval from the IRS. Real quickly, let's touch on 163J. So as I'm sure most of you are probably aware, the TCJA limited the deduction for interest expense to 30% of a taxpayer's adjusted taxable income, or what we'll abbreviate as ATI, for the tax year. The CARES Act came in and increased the ATI limitation from 30% to 50% for tax years beginning in 2019 for C Corps and S Corps, and I'm sorry, in 2019 and 2020 applicable to C Corps and S Corps, only 2020 applicable to partnerships. And in addition, and here's where it can get really beneficial, for any taxable year beginning in 2020, an election can actually be made to use your 2019 ATI in lieu of using the 2020 ATI. So what this all does collectively is it really gives an opportunity to take an increased interest expense deduction and therefore possibly increase a loss in a particular year, which, as we discussed, is eligible for carryback. The potential election to use the 2019 ATI is also particularly advantageous because many taxpayers are going to have higher adjusted taxable income in 2019 as opposed to 2020. And so you can use that to really boost up your limit and therefore take a higher interest expense. Taxpayers may in fact elect out of taking the 50%, and there are situations, once again, just like where it's not advantageous to utilize an NOL carryback, it might be more advantageous for some taxpayers, depending on their situation, to keep the limit at 30%. Depreciation, and it's such a vast amount of things with depreciation, but there's a lot of potential opportunity to increase deductions with fixed assets. So, you know, I mean, some of the common ones are always things like taking bonus depreciation, which a lot of people do, although some don't, depending on their situation. Options to accelerate fixed assets into shorter recovery periods. Another one is, you know, for people implementing cloud-based software, ERP systems, and things like that, the possibility of looking into being able to deduct versus capitalize some of those expenses. So cost segregation studies and just a general review of your fixed assets are a great way to look for opportunities that you can claim additional depreciation deductions. And some people might even find the correction of the retail glitch to qualified improvement property that was made in the CARES Act to be an opportunity as well. So this is now eligible for bonus as a result of that technical correction. A 263A, a vast abyss that this is, taxpayers that are subject to UNICAP rules often have a tendency to overcapitalize costs due to the complexity of the rules. So opportunity exists, do a method change, possibly get that capitalization down, recognize a deduction. You know, just as an aside, for many taxpayers, there were new rules that came out regarding new regulations regarding 263A. So it's probably a good time to take a look at this anyways. And for taxpayers with less than 25 million of gross receipts, this is calculated gross receipts for the prior 3 years, on gross receipts calculated for the prior 3 years, may actually have the opportunity to discontinue capitalizing costs. This came about as in the TCJA and was a change, and you know, a lot of taxpayers that fall in this range took advantage of it. Some did not, depending on the situation. Maybe it wasn't a great answer before. Maybe it is now, worth a second look. Accrual to cash method changes impact that same group of taxpayers that meet the gross receipts test as well, and are another potential opportunity to accelerate deductions. So in general, a lot of the items on this slide I'm not going to get into in detail, once again, fall into the same area: accelerating deductions, deferring revenue. I recommend doing a review of your GL with your tax advisor. Make sure that everyone understands what methods are in place and look for opportunities, because there definitely could be some in there. Something I didn't have on this slide, and I'm not going to go into detail, but there's also potential to accelerate losses due to natural disasters. This falls under Code Section 165, and when certain declarations are made by the President under the Disaster Relief and Emergency Assistance Act, which they were, there's the ability to accelerate sometimes certain deductions that are going to occur, will occur in 2020 back to 2019. Important to note, not every deduction qualifies. There's a list. You definitely want to consult with your tax advisor if you think that there's any opportunity there. And the last item I had listed on this slide before we're going to take a really quick look at an example to see how this can all work to your benefit is filing for a quickie refund on Form 4466. If you overpaid your estimated tax for 2019, you can apply for a quick refund of these taxes. So something, you know, maybe your taxable income was set for 2019, but now you realize as a result of some planning strategies, you're going to make some changes, it's going to be lower, or maybe you had intended to use some overpayment from 2019, apply it towards your 2020 taxes. Well, 2020 is not looking so hot now, so perhaps now you want to get that cash back because you might not be in a position where you're paying in taxes in 2020. So all good things to look at. Okay, real quick example just to illustrate this. So the facts here on this slide is that Emerson Company is a domestic C Corp. It's going to have $6 million of taxable loss in 2019 before utilizing any planning strategies. The company generated $10 million of taxable income in 2014 and has had taxable income ever since. Emerson doesn't have any tax deductions or credits that are going to be limited by taxable income, nor did it ever in the past. And after doing a thorough review of the trial balance, evaluating accounting methods, it determined that it can accelerate deductions to generate an additional $1 million of NOLs in 2019. So let's just take a look at how something as simple as this very plain vanilla example can increase your cash benefit. So you'll see under the column that has no method changes, the taxpayer, by carrying back the NOL, was able to reduce their tax liability from $3.5 million to $1.4 million and get a refund of $2.1 million. Okay, well, that's great. That's a lot of cash. Who wouldn't want that at the end of the day? However, take into account those method changes. An additional $1 million of NOL has the ability to actually generate an additional $350,000 of tax savings. So pretty good deal there. There's maybe a little bit of cost to pay to your tax accountant to help facilitate the filing of these method changes and things like that, but you're definitely getting bang for your buck here in this situation. So I encourage you to look at that. And the last thing I am going to touch on now is all of these planning procedures sound great. Yay, I'm going to have lots of opportunity to maybe get additional deductions, carry back even more NOL, get even more cash. Well, I'm going to put the brakes on that a little bit and give you a few things to consider before you go gung-ho and get all excited about that. So after all, I do work in tax. Sometimes I have to bear bad news. The carryback of NOLs can actually impact a number of credits and deductions that the corporation had previously claimed. And some of those provisions to consider are Section 199, Domestic Production Activity Deduction, or DPAD, which was eliminated as a result of TCJA. So really 2017 in general was the last year that taxpayers could take advantage of that. But this deduction was quite significant for a number of taxpayers. It was actually limited to taxable income. So an NOL carryback could reduce the DPAD deduction significantly or entirely. So you might not be getting as much bang for your buck with the NOL if it eliminates DPAD. General business credits are also a really tricky area. They're generally non-refundable and generate a 20-year credit carry forward. So the carryback of an NOL could reduce or eliminate your ability to use credits such as R&D and FTCs, in which case they would then need to be carried forward. And there's always the potential then it could expire and never be used, or maybe the taxpayer is now not in a position to use it. So you want to watch out for that. AMT definitely has various nuances. I'm not going to get into all the details. AMT credits are ultimately refundable and were actually expedited under the CARES Act, but there are some nuances there. Multinational taxpayers need to watch out for the 965 transition tax, GILTI, and FDII interactions. There can be some negative impacts there. Also, short tax years come into play and how to treat them. If you're a taxpayer that underwent any M&A activity, rules really to watch out for there. Who would even own the benefit of these NOL carrybacks? There's some tricky rules that can be involved there too. So there's definitely some potential pitfalls and things to watch out for that make this more complicated than meets the eye on the surface. So now we're going to take a look at a quick polling question. Just wait for that to bring up. Okay. So does your company or shareholder currently have NOLs or expect to generate NOLs that it will carry back? Yes. We have already generated NOLs or will generate NOLs that we will carry back. Maybe we are still evaluating our options. No, we have not generated or will not generate any NOLs. And lastly, I don't know. Now, I am going to go ahead and transition this over to Nick. But, kind of in summary, the NOL carryback provision of the CARES Act provides many opportunities to increase liquidity. But the key to maximizing liquidity is doing a thorough analysis to find the most advantageous ways to utilize this benefit. Thank you. Over to you, Nick.
All right. Thank you very much, Carrie. Good morning, everyone, and thank you all for joining us today. So we've got about 10 minutes left here before the top of the hour, so I'm going to try to move pretty quickly through this. Here's a brief agenda that we want to walk you through: our view of equity and fixed income markets, then take a broad look at core and satellite asset class returns, provide an overview of market opportunities we're seeing, and then wrap with our key takeaways. So again, it's a lot to cover. I'm going to try to move pretty quickly. If you have any questions on any of this, please feel free to reach out and follow up afterward, as we're more than happy to go into detail. So what you're seeing here is a chart of the performance of the S&P 500 year to date. This is as of yesterday's close, so it doesn't reflect the nice little rally we're getting here today, but of course that doesn't change the observations. What you'll see on the chart is the yellow arrow at the top left is pointing to the all-time high on the S&P 500 of 3386. That was reached just about 2 months ago on April 19th. The red scale here just shows that the market sold off nearly 34% through March 23rd. The red arrow there is just pointing out that this recent decline took us well into our bear market territory, which is generally defined as a 20% decline. On the right-hand side of the chart, the white scale shows the subsequent 25% market rally that occurred from March 23rd through yesterday. The purple arrow simply indicates that this rally technically brought us back out of a bear market into a fresh new bull market. So within just 2 months, equity markets collapsed in dramatic fashion, declining 34%, then rallied back over 25% to close out yesterday at $27.99. And now here we are today, trading down about 17% below the all-time high. Okay, so what made it such a wild 2 months? Well, it was the coronavirus, of course. But the other culprit here was volatility. This slide here shows the VIX, or the Chicago Board Options Exchange Volatility Index. This represents the volatility of the S&P 500. At the top middle of the slide, the yellow arrow is pointing to the all-time high on the VIX of 89.53, which was reached intraday on December 31st of 2008 during the financial crisis. In the upper right-hand side of the slide, the red arrow points to the high that we just recently experienced. And you can see here we touched on March 18th up at 85.47. This chart shows the VIX going back to the early 90s. The purple line that goes across that chart is the historical average, which comes in at 19.6. So you can see what we experienced up here was really an explosion of volatility, where we hit levels that were over 4 times the long-term average. The purple circle on the right-hand side of the chart just shows where the VIX closed yesterday at 40.11. So for now, what's all this mean? The good news is that volatility has come down from very extreme levels, although of course it still remains very elevated relative to its long-term average. And it's something we're going to continue to keep an eye on. So what can we do about all this volatility? What we can do is remember, don't try to time the market. The table on the left here shows the worst 15 days in history for the S&P 500, and the table on the right shows the best 15 days. As you can see from the red boxes on the left, we had 2 of the very worst days in the S&P's history in March. What you can see on the right is that we also had 2 of the very best days in the S&P's history, also in March. More specifically, the lower red box on the left is from March 12th, where the S&P sold off 9.51% in one day. But if you follow the red arrow down to the lower green box on the right side, you can see that the very next day, the S&P rallied 9.2% on March 13th and made nearly all of it back. Of course, coming back to the table on the left, a few days later on March 16th, the market sold off again to the tune of 11.98%. But then you follow that red arrow down, only 8 days later, the market rallied back 9.38%. So it's really quite amazing what we've just experienced. Ultimately, if you meet someone who says they predicted all this and sold their stocks right before the sell-offs and then got right back in before the rallies, I think you better hang on to your wallet, because it's pretty safe to assume they're telling tall tales and trying to sell you something. The final lesson of this slide is that you can't simply buy on the worst days and just wait for the rally either. The reason for that is what you see in the pink shaded box at the very top of the table on the left. You never quite know how bad the sell-off will get. That row represents Black Monday in October of 1987. Now, the table on the right does show that 2 days later, after on October 21st back in 1987, the market rallied back 9.1%. But the key here is that you can't time these market movements. More often than not, if you sell into weakness, you end up selling near the bottom, and you rarely know when to get back in to catch all the comeback. So what we're looking at here is equity valuation. This slide shows equity valuations over 10 years for U.S. large, mid, and small cap stocks. These are price to earnings ratios, or PE multiples, over time. The S&P 500 U.S. large cap is at the top in green. The Russell mid cap index is in the middle in blue. And the Russell 2000 or U.S. small caps are at the bottom in yellow. The white line across each chart shows the 10-year average multiple for each asset class. And the circles on the right are the current levels of price to earnings ratios. The white text in each chart shows the 10-year average multiple for each asset class. As you can see, despite the recent declines in the S&P 500, U.S. large cap remains just about fairly valued at only a slight premium to its 10-year average. Meanwhile, U.S. mid cap trading at 18.3 times is actually trading at a discount to its 10-year average of 21.2. And at the bottom, U.S. small cap, which trades at much wider ranges given its historical volatility, is trading at 32.7 times, representing a significant discount to its 10-year average of 39.1. So ultimately, we believe there are some opportunities to pick up good long-term value in this current market environment with the sell-off that we've experienced. So these are similar charts, but for two different additional asset classes on the bottom two panels. The top one is green. In green is the S&P 500, again, just for reference. The middle chart is the MSCI International Developed Equity Market Index in orange, and the chart on the bottom in purple is the MSCI Emerging Markets Index. What you can see is that both international and emerging market stocks are trading at modest discounts to their 10-year average valuations. So much has been made, especially prior to the pandemic, about these valuations in foreign markets looking attractive. However, we would be cautious there, as we believe these valuation gaps could persist given deeper structural issues in those economies, in those particular markets. So ultimately, this is what we're seeing with valuations. It's very important to note that you can't trade on valuations alone, and it is particularly difficult to trade on valuations in this current environment, given the lack of clarity around forward earnings. Obviously, there is a lot of uncertainty still around economic conditions, which will ultimately have a significant impact on earnings going forward. So that is something to be mindful of. That level of caution speaks well to this next slide. This is risk on, risk off. These are S&P 500 companies. Our final slide on equities here gives us a picture into individual equity factors, which ones are working versus which ones are not working. You can think of these charts as a good picture of whether investors are putting risk on or taking risk off. The reason for that is the top three charts in the green rectangle represent risk-on stocks, or stocks with factors that investors want to buy when they want to take more risk. The chart at the top left shows the performance of companies with low price-to-earnings ratios. The chart in the top middle shows companies with high leverage, and the chart on the right shows companies with high beta. As you can see from each of those charts, the performance of those companies began rolling over and declining at the beginning of the year, and then rapidly accelerated their declines when the crisis hit. Only recently did they start to bounce back, but then each of them has rolled over again as investors have gotten a little bit more cautious. Conversely, the charts on the bottom represent risk-off stocks, those in the red rectangle. Those are stocks with factors that investors buy when they're getting more defensive. These are also called high-quality stocks, or quality factors. The bottom left chart shows performance of companies with high long-term growth in revenue and sales. The chart in the bottom middle is companies with high return on assets, and the chart in the bottom right are stocks with high momentum in share price. Of course, what you're seeing here is the opposite of the risk-on companies, where each of these charts, they were low or trading sideways at the beginning of the year, but then they rapidly spiked as investors became more defensive and began buying higher quality companies. This is a classic flight to quality trade. You can see each of these charts recently peaked out and appeared to roll over as the market started to put on a little more risk in the last few weeks. But now they've begun to hook up again as investors remain a little bit more cautious. Ultimately, we expect that given the uncertainty in the economic environment and the lack of clarity around earnings, higher quality stocks will likely to continue to outperform in the near term. Switching gears to fixed income, this chart shows the year-to-date performance of core U.S. fixed income asset classes. In the blue, from left to right, you have U.S. Treasuries, which performed extremely well this year, U.S. agencies, which also performed well, U.S. corporate bonds, U.S. mortgage-backed securities, and then municipal bonds, which are roughly flat in the year. The green bar on the left is the U.S. aggregate bond index, which is comprised of all of the other bond asset classes except for muni bonds. What you can see here is that in the midst of a major equity market disruption, the U.S. bond aggregate performed very well, including specifically higher credit quality bonds such as treasuries and agencies. So the lesson here is that having core bonds in your portfolio provided good diversification from equities when you needed it. Ultimately, they served their purpose in your portfolio very well by preserving capital while equity markets got hit, in addition to providing some interest income along the way. On the other side of the coin, in contrast, this next slide shows non-core or satellite fixed income asset classes. Here you have U.S. and global high yield in the first two bars, then you have international emerging market bonds in the next two. Obviously, each of these asset classes have sold off year to date, and outside of international bonds, they have declined quite significantly. It's generally no surprise that these asset classes are historically more risky than core bonds, but the comparison to core bonds shows how owning these bonds instead of core bonds did not provide you with sufficient diversification from the equity risk. So digging into U.S. fixed income a bit further, this chart shows U.S. corporate credit spreads. Credit spreads represent the additional yield above the U.S. Treasury yield that a corporate bond offers, given its added credit risk. These spread indexes serve as a proxy for how risky investors view bonds of different credit quality. These spreads are also viewed as a proxy for how well the economy is doing. Wider spreads or higher number on this chart represent economic duress, while tighter or lower spreads are generally viewed as a sign of a solid economic environment. There are three types of spreads represented here. The white line is AAA credit, or the highest credit quality. The blue line represents BBB, or the bottom end of investment grade, and the purple line represents high yield, or bonds that are below investment grade. What you can see here circled in red is that spreads blew out significantly in March with the recent crisis as investors sold off credit across the entire credit spectrum. What was notable is that investors threw out even the highest credit quality bonds, the white line, while the BBBs, actually the blue line, actually held in reasonably well. With the Federal Reserve setting up programs to provide liquidity to primary and secondary credit markets, spreads came back in significantly, although they've experienced some meaningful volatility since the Fed's announcement, as it has taken some time for those programs to get up and running. What is also notable is that high yield spreads have remained wide given the uncertainty in the economic environment and the fact that while the Fed provided some support to fallen angels, they did not provide broader support to high yield markets. So fallen angels are those companies that were previously rated investment grade that have recently been downgraded to below investment grade. So in the essence of time, I'm going to skip through a couple of these next charts on corporate credit spreads. Suffice it to say that we see opportunity within corporate credit, including both investment grade and high yield. Which brings us to asset class returns. This table shows us the returns for various core asset classes over multiple time periods. The group of 5 in the top represent global equities. You have U.S. large cap followed by U.S. mid and small, then international developed and emerging markets. On the bottom, below the line, you have bonds, starting with the U.S. bond aggregate and then municipal bonds. You can see this shows total returns year to date, 1 year, 3 year, 5 year, and 10 years. Obviously, while equities are rallying today, they have sold off pretty hard this year. Traditionally, higher volatility asset classes like U.S. small cap have been hit particularly hard. All that said, it's very important to note that we don't own equities for how well they perform this month or the next quarter or the next year or even the next 3 years. We own them because of the kind of total return they deliver over a long-term time period like 10 years. So obviously, as you look at this list, despite the market decline, these core asset classes have still delivered very attractive total returns over the last 10 years, especially U.S. stocks in the S&P 500, which is tracking at over 11% total return over the last 10 years. The U.S. bond aggregate has also delivered 4.8% this year amidst equity market sell-off, while delivering 11.3% total return on a 1 year basis. That's pretty extraordinary for your typically run-of-the-mill treasury, agency, and investment-grade corporate bonds. So muni bonds have also held in reasonably well and have maintained their value. But the key here is when you look at both of these asset classes on the fixed income side on a 10-year basis, they've provided very steady and stable total returns that significantly outpaced inflation. Switching to satellite asset classes, that brings us to our non-core asset classes. It's important to note these are asset classes that tend to be a little more risky, especially in good times, and they tend to cost a little more to get these exposures, which investors generally get through actively managed funds. Starting at the top, you have U.S. corporate high yield, you have global high yield, you have the preferred stock index, then REITs or real estate investment trusts. After that, you have MLP index or master limited partnerships, which tend to be oil and gas plays. Then you have commodities there with the Dow Jones Commodity Index, followed by the private equity index, and then the global hedge fund index. So the main thing that jumps out to me from this table is that most of these asset classes don't rival the returns of basic vanilla U.S. stocks on a 10-year basis. So in many cases, especially during good times, you're adding risk to your portfolio and you're paying up to get these exposures, but you're getting long-term returns that have significantly underperformed the S&P 500. Much has been made about the diversification benefit of these asset classes, but as you can see in the year-to-date column, most of these have been hit pretty hard along with equities. So they haven't provided a great deal of diversification, and they certainly haven't filled the role that core bonds have filled this year, as we had touched on a moment ago. When you look at some of these asset classes in particular, REITs are down pretty significantly this year. MLPs have been hit really hard and down over 55% on a one-year basis. So of course, on a 10-year time horizon, many of these asset classes have lost money, and that's before you consider the underlying expenses. The lone asset class that performed well in this group is private equity, which delivered almost 14% in total return over 10 years. It's notable that during times of market duress, though, like we just experienced, even private equity sold off hard. And that's because this asset class and some of these asset classes get hit particularly hard given their illiquidity. You can see that showing up in the year-to-date and the one-year numbers for private equity. And finally, you have hedge funds. Of course, they've delivered almost zero total return based on this index for the last 10 years. And that's before you've paid the 2 and 20 fee structure that used to be typical of those types of investments. So ultimately, the key here is you have to be careful investing when people are pitching you these non-core satellite asset classes in the good times, because in many cases, they're not worth your time and money. At the end of the day, one thing I learned early in my career is that if you're going to take risk, you have to get paid for it. Many of these investments simply don't pay for the risk, especially over the long run. So to summarize the market opportunities that we're seeing, while we never invest on valuations alone, equity valuations in the U.S., small and mid-cap look attractive relative to recent history. International developed and emerging markets also appear attractive from a valuation standpoint, although we feel that valuation gap may persist due to structural economic issues. We expect higher quality stocks to outperform in the near term as the risk on trade remains on hold for now. And we see opportunities in investment grade credit given dispersion. We also want to consider being very selective in U.S. high yield. Which brings us to our key takeaways. At the end of the day, always invest with purpose. Know what you own and why you own it. Recognize here that the market is trading on sentiment, not fundamentals. Stay disciplined and don't try to time the market. High quality bonds, they've served their purpose in preserving capital and providing good diversification. In these times, consider rebalancing your portfolio to right size your positions and ensure your asset allocation reflects your long-term risk and return targets. And ultimately, we're looking closely at financial conditions, which remain supportive of asset prices, but we do not yet see the upside in the risk on trade until there's a little bit more clarity around the economic situation and earnings. So with that, I'm going to pass it over to Eric to close it out. Thank you very much for your time.
All right, and we have a final polling question. This question is optional, it's not required. You're welcome to put that up, Steph. And this is more a question for you to let us know if you would appreciate some follow-up from RKL on any of these topics that we've talked about today. So if this is a way, especially as we're all remote, if you would appreciate some kind of follow-up from the firm, just check one of these boxes and our team will get back to you. The first option being the PPP loan forgiveness discussion and the cash flow forecasting. Again, we just touched on that a bit here today. Next week, our webinar will have a lot more content in that area. Net operating loss planning, remote cybersecurity, HR, and payroll matters, maybe some investment discussion around your own risk profile in your portfolio. I have other questions, please contact me, or no follow-up is necessary. So with that, thank you for being with us. We hope you'll join us next week. Thanks a lot. Bye-bye.